Hello, ladies and gentlemen. My name is Greg Michalowski. I'm the Chief Currency Analyst for FXDD, and I'm very honored and happy to be here at FX Street for a special webinar presentation for our friends at FX Street. Here are all my particulars. My email is greg@fxdd.com. You can write that down in case you want this PowerPoint. Just send me an email. I'll be happy to send it off to you. I'm on Twitter. My Twitter address is GregMikeFX, and I also have web commentary throughout the trading day. Before we get started, let me remind everybody that trading is risky. Traders should only use risk capital that they're willing to lose. During this webinar, I'm not necessarily going to give you any buy, sell, or hold recommendations. It's purely for educational purposes only, so please keep that in mind when viewing this webinar, either live or on the rebroadcast. We have a good crowd in here today, so let's get started in our program. I'm going to be with you for about 45 minutes to an hour. If you have any questions, please type them into the question field in your screen there. If I don't get to them as you type them, don't feel slighted. We'll get to them at some point or during the presentation, but this will be like a lesson type of plan here today, whereby I'm doing a lot of examples toward the end. At the beginning, I'm going to build a little bit of a foundation, and just to keep on track, keep on target of what we're trying to do. I'm going to be moving along there. But we will get to your questions as the program goes on. But before we get started, I just want to build this foundation for traders, and I have a mission statement for all traders, and that mission statement is to make the most money with the least amount of risk. To make the most money with the least amount of risk. And you'll see the importance of that when we start to talk a little bit more about Fibonacci retracements and what they are and why we use those that tool, why I use that tool in trading and analyzing the market, and why it's so important for me as a trader. But a basis of our trading, of our knowledge, of how we're going to approach the market comes from our trader's mission statement, and that is to try to make the most amount of money. If we're not here trying to make the most amount of money that we possibly can, doesn't necessarily mean you're going to even make money. It's just going to mean that you're going to try to make the most that you possibly can make. And sometimes, some of you aren't, don't have the skills necessarily to make money in this market. But coming to these sessions are going to increase your knowledge, increase your skills, and hopefully get to that point where you can make money in the trade. The least amount of risk is the other side of the mission statement. I'm not saying don't use risk. Of course you have to use risk, but you should always be cognizant of trying to use the least amount of risk. It makes sense. You don't want to have too much risk. Oftentimes traders take too much risk, and what do? They lose too much money really quickly. So you have to be able to define your risk and understand your risk, and that is a way toward defining the least amount of risk. Anyway, that's a big, broad picture. How are you going to go about making the most amount of money with the least amount of risk? And that gets into my game plan. The trader's game plan is to trade trends and keep fear to a minimum. If you use the least amount of risk, guess what that's going to do? It's going to allow you to keep your fear to a minimum. And I always say fear is a trader's worst enemy. You have to steer clear of fear. Anything that you do in life where you have a high degree of fear, you're not going to be performing at your peak. Think about it. Think of examples where you've had fear, and you can prove that statement. The same goes true in trading. If you have fear, you're going to get out of positions too early. You're going to stay in positions probably, and have hope trades at times. You're going to take quick loss. It's just not good to trade with fear. You're not going to do well. You have to have confidence. You have to keep your fear down, and on the other side is trading trends. That's how you're going to make the most amount of money in forex trading, folks, is by trading trends. And Fibonacci retracements have a lot to do with trends, although they are used mainly in the counter trends within the trends, and we'll talk about that in detail as we go on. But what I want you to focus on first is that trends do not go up or down in a straight line. We all know that. That's pretty obvious. Is that the trend will move up and then it will correct, and move up and then it'll correct, move up, it'll correct, or move down and it'll correct, it'll move down and correct, and move down and correct. That's part of a trend. Is that's this rhythm to the market, and this rhythm is not necessarily all, it hurts a lot of traders if they're not trading the market with this knowledge in mind, and so so it's important to understand about these retracements and understand as much as you can. And Fibonacci retracements come in hand with that. Prices go up and they go correct and they go up again further and they correct even further. And corrections can be painful. Those corrections that may take 200, 300 pips in a longer-term correction. It may take something less in a shorter-term intraday correction, but they are painful. How many times have you gone into the market, bought the market because the market was moving to the upside, and then you get this correction? Right when you get into the market starts to correct, and it corrects down right to that point where you just get out, and then the market moves back to the upside and trends to the upside. My goal is to try to lead you toward that point where the corrections aren't painful, where the corrections can be helpful to your trading, as a matter of fact. But corrections overall can cause traders to get out of sync with the rhythm of the market. This buying a high and then having the market move back to the downside. You're automatically out of sync with the market when you're at the wrong level and the market starts to correct. And when you're out of sync with the market, what does it do? It increases your fear. And what is our game plan? To try to keep fear to a minimum. So we're working against our game plan. Fear is the trader's worst enemy. Fear makes traders do things that they tend to regret later, and traders want to, what I like to say, steer clear of fear. A nice little rhyme that you can remember. Put it down on a little note card. Make sure that you understand that you as a trader have to always try to steer clear of fear. Fibonacci retracements measure corrections, and this is why it's an important tool in my game plan of trading trends and keeping fear to a minimum, because I want to, if I can understand these corrections a little bit better, if I can measure these corrections, if I can get back on trends during these corrections or enter on a trend move during a correction at the right level where I'm not going to have fear, where I'm going to be able to trade with the trend, I'm going to be better off as a trader, because trends are where traders make the most amount of money with the least amount of risk. It's that simple, folks. Trends are fast, directional. Trends move in ranges that are outside of normal. Just look at today, and that is what we're trying to take advantage of. And if we don't take advantage of the trends, then we're not going to make as much money, the most amount of money that we possibly can. And we have the chance, if we trade against the trend, to lose a lot of money very quickly, very fast. So Fibonacci retracements are an important component of this whole idea of trading trends. Fibonacci retracements help traders control their fear. That's our game plan. Fibonacci retracements help traders get back on the trend. That's part of our game plan and our mission statement, because trends are where you're going to make the most amount of money. Fibonacci retracements can be used to define risk. And if you can define risk, guess what? You're able to keep your fear to a minimum. Traders who can say, my risk is if this price goes below this line, below this Fibonacci level, below this moving average, they're the ones that can define their risk and know where they are right. If the market stays above that line, they are right. If the market goes below that line, they get out. And they limit their risk by defining the risk, and by defining the risk, they're able to keep their fear to a minimum. See how it all kind of comes together in this complete ball that has, that there's no breakage along the way. Fear, defining risk, being able to trade corrections, under corrections, all part of, and trade trends, all part of our mission statement, all part of our game plan. And the most important thing, I think, is that, or one of the most important things, they're all important, but one of the most important things as well is Fibonacci retracements are used by forex traders in the forex market. I see that the Fibonacci retracements tend to find support, find resistance at the levels, and that to me is an indication that not only I am watching this, but other traders are out there are watching it. And folks, where you as a retail trader sit, you need to be able to listen to what the market is saying, listen to what the other traders are saying, not necessarily what you are saying. You have to have followers along with you. And if those followers are using Fibonacci retracement levels as levels to define risk, as levels to measure corrections, then you should be using it as well. And the more that people use these retracement tools or this tool, the better off you're going to be. But what I've found through my 27 years of trading is that Fibonacci retracements do have an important part in trading, especially in the foreign exchange market. The foreign exchange market really, forex traders tend to really like the Fibonacci retracement. So what is a Fibonacci retracement? A Fibonacci retracement, and I'm going to spend just a little time on this, is a calculated value derived by using numbers from what is called the Fibonacci sequence. Now, I don't want to necessarily get into how the Fibonacci sequence is used in the order of nature and stuff, but I do want to talk a little bit about the Fibonacci sequence. The Fibonacci sequence starts with the number 0, and then you add 1. When you take 0 and 1 and add it together, you get 1. When you take 1 and 1 and add it together, you get 2. When you take 1 and 2 and add it together, you get 3. 2 and 3, you get 5. 3 and 5, you get 8. You get the idea of the sequence here. The sequence was initially used, in a kind of fun fact type of way to estimate the growth of the rabbit population centuries ago by a mathematician who had named Fibonacci. He has a nice long Italian name, but it has been shortened in the market in the order of science to Fibonacci. It's called the Fibonacci sequence. And what the markets have figured out, I guess, and not really sure how this how it all came about, but if you take two successive numbers in the sequence and divide the lower number into the higher number, like 144 divided by 233, you get a value that is roughly equal to 61.8%. And here's an example: 144 divided by 233 gets 6.80258 rounded to 618. And then you can take any successive numbers like 610, 987, and you get roughly the same number, 618. So 61.8% has been earmarked, I guess, by the market as a retracement level. It's one of those numbers that fit in nature for a rhythmic type of move, which trends are rhythm move that moves up in one direction, comes down, moves up, comes down, and 61.8 becomes a Fibonacci number. And if you take that same sequence and you take one number and then you skip a number and take the other number and divide the lower number into the higher number, like you do right here in this example, you get another. Excuse me. Let me get a drink. Thank you. You get another constant, which is 38.2, and here you have 38.19 rounded to 38.2. 144 divided by 377. If you take 377 divided by skip the 610, it gets 987. What you get is 3819 rounded up to 38.2. So guess what? The second Fibonacci number is 38.2. So we have 61.8 and 38.2, and that's those are two key Fibonacci retracement levels. Now the market has adopted another one. The midpoint 50% is another level that the market's going to be paying attention to, and that is just the midpoint of a range. But Fibonacci's are calculated off of a high to low range, and so if you have a move to the upside that takes 100 pips to the upside, you measure 38.2 from that, and you get 71.8 as off of that high, or 38.2 pips off of the 100 pip move. You measure that from the high down, and you subtract 38.2 from that 100 pip, whatever that high price is, and you get the retracement level, and that's basically what Fibonacci retracements are. And we'll get into charts for those people who may not understand or cannot visually see that. We're going to take a look at a lot of charts in just a second. So the correction of trends are measured using the 38.2% retracement, the 50%, and the 61.8% retracement. Those are the ones that I pay attention to the most. There are other ones that before 38.2 and after 61.8 that traders might or you might hear as Fibonacci points. I tend to not consider them in my trading. I tend to focus on these three retracement levels And in trending markets, I tend to really focus on the 38.2 and the 50% retracement. If the market corrects more than 50% in a trending market, it says to me it's not necessarily a trending market. So, but 38.2 has real big importance in the trending market, and I will demonstrate that when we start to look at a trending market and how to use Fibonacci retracements effectively in your trading. So, so think of Fibonacci retracements as levels to patiently enter a position after the market starts to trend. The market's trending to the upside, and then you're not on that trend. You miss that first move to the upside, that first leg to the upside. You want to get in on a long wait for the market. The market's eventually going to have a tiring moment. The market's going to calm down. The market's going to have some consolidation that allows the buyers and sellers to get more comfortable in their position at this new higher level or lower level, and then the market will tend to have a little correction. And if you can patiently wait to enter on that correction against a Fibonacci retracement level, you may find that the market will give you a nice level where you can define your risk, and a nice level where either you're going to be right and the market's going to continue the trend in the direction of its original leg, or you're going to be wrong and you lose a little bit on the trade. That's part of trading, folks. No one's guaranteeing you anything. So don't be afraid to measure corrections and act, especially in what you think might be a trending market. So this picture was taken before the market broke out here today. But what we've seen of late in a non-trending market is a lot of movement above and below what I had here as Fibonacci retracements. And quite frankly, I put this slide first because in a non-trending market, what the importance of Fibonacci retracements become less in my mind. Okay, they give way to other levels of ceilings and floors, these horizontal sort of trend lines here that I have in the chart. Those levels become more important to me as opposed to 38.2% retracement, 61.8 or 50% retracement. There's really no, if you're retracing a trend, there's no trend in a non-trending market, and that's what we've seen over the last 9 days until today when the market broke to the upside. So the role of Fibonacci retracement becomes less important. Now, what I do, if there was a Fibonacci level that I will pay attention to, it's a 50% retracement level. That is sort of the fulcrum of a non-trending market, the apex of a seesaw, the swing from bullish to bearish, if you will. And when the market came down sharply and defined the 201 pips that we've been in over the last nine trading days, with a high here and a low right here, you can see how around the 50% retracement there is a move to the upside, came down to the 50%, move to the downside, move above the 50%, move to the upside, come down to the 50%, move to the upside, break below the 50%, move to the downside, break above. You get the point here that something tends to happen around the 50% retracement. And today when the market broke above that 50% retracement, broke above these two lines here, my 100 and 200 hour moving average. We're on the hourly chart here. And when the market broke above the 50% and the 100 and 200, we started to see a little bit more momentum to the upside, and trade just true to form here at that 50%. So just keep that in mind in a non-trending market. Fibonacci's aren't, the 50% retracement is kind of my key level to watch. It's different in a trending market. I like to use the 38.2 as my key Fibonacci retracement level, and we'll get into looking at that in just a second. So now that was a non-trend market, and what Fibonacci's are, where I find them most advantageous is in trending markets, and trending markets are where you're going to make the most amount of money with the least amount of risk, right? That's part of what we know about trends is that's where you have to get it right, folks, is in trending markets. And Fibonacci's are an important part of that trending market. So before we entered into this non-trending period, which started at this point right here, what was the euro in? The euro was in a trending market. We were trending to the upside. You can see how the market had a low here at 126.23, and we moved all the way to 132.26 was our high price that we saw on January 30th or so, somewhere around that level. So right here at this point right here. So that move to the upside took about 600 pips, as a matter of fact, to the upside, just a little over 600 pips. It was 26 was the high, and the low was 23, so 602 pips all the way to the upside. And that's what I would consider, folks, a trending market. So what I thought I'd do is take a look at this trending market and show you the use of Fibonacci retracement levels as that trend continued, and how I like to use the Fibonacci retracements as the market is moving in this direction, is moving sharply to the upside. So we're gonna piece together each of the legs here, if you will, and come to understand how I like to use the Fibonacci retracement levels, and how I think the market also likes to use the Fibonacci retracement levels in managing and measuring the corrective moves. And I think you'll find that there is definitely a rhythm to it, and a way that you can better prepare and better understand these corrections, so that you don't have that fear. So you're able to trade in corrective phases with confidence, and perhaps even get back on the trend, or get on trends that you missed earlier. They're just a very powerful tool. So let's go to the beginning here. This was our low back on January 13th, and or actually 16th was I guess a low on the 13th and equaled on the 16th. So this is a Friday. This is a Monday, and the market gapped a little to the downside. Had a very quiet Monday, and the market shot up on a Tuesday. And here this move to the upside here took the price from 126.23 to 128.07. It doesn't look like much in the scope of this whole move to the upside, but you figure out that's about 180 or so pips to the upside of the market moved. So it's a significant type move. So when the market moves to the upside and starts to correct like it does here, I always automatically start to put in my Fibonacci retracement. I'm going to measure 38.2. I'm going to measure 50%. I'm going to measure 61.8% on that move to the downside. And you can see here how the market came down at 38.2 and kind of stalled. And we have a couple moving averages here as well. And this is the beginning of a trend. Our moving averages starting to move sideways. So you can tell that the market at this point is kind of in a non-trending. We don't see what occurred before. We know that the market came down from this level, but we also know that the 100 bar and the 200 bar moving average are starting to go sideways. They're starting to converge. So that suggests that before here was kind of a non-trending market as well, an up and down type market, which caused the two moving averages kind of come in between a range. That's what these moving averages tell you. And if you look back at this time before this chart started, you would see exactly that. In fact, I think we were in about the 260 or so pip range for the period before that level in a non-trending up and down type market. Now, so the correction came down toward around the 50% retracement, and then we moved up a little bit. And where did we go? We went right up to our old high right here for the day, and then corrected down. And where did we correct down to? We corrected down right to that 38.2% retracement. Remember, I like that 38.2. I like corrections that hold the 38.2. That says to me that the market has some power behind it. It has some buyers, if you will, who are happy to not get to the 50% retracement, but to be aggressive and buy against the 38.2% retracement. That is a good sign. That is a good clue for you as a trader, and it doesn't necessarily mean it's going to be right all the time, okay? The person who bought right here against the 38.2, it went up a little and then it came back through that level. Fine, that's part of trading. But when you start to see something like this happen and it comes down again to that same 38.2, And note here what else is right at that level, the 100 and 200 bar moving average. We're not necessarily going to spend a lot of time on that, but those are my two favorite moving averages, and people who have heard me before know that I like to use those two moving averages. So here we have the situation where I have the 38.2, I have the 100-hour moving average, I have the 200-hour moving average, and the price all converging at the same place. Is that like a key level? I mean, it's like a key level. Is that a key level? Yeah, that's a key level, folks. Something is going to happen at that level. Either we're going to go down and we're going to break below this level and the market's going to continue to the downside, maybe probably go test the lows for the week, or if this level holds, that's something. That is a clue. That is something you can grasp onto. Pick that fruit off the tree and eat it, okay? This is what you are looking for as a trader, is those two moving averages going sideways, converging, non-trending leads to trending, and a 38.2 coming together. So in my book, and I do have a book called Attacking Currency Trends, and by the way, this is a very important part of the book. But in my book, the 38.2% retracement holding that level and the 100 and 200 bar moving average coming together, what a key level to get in on. And if you're lucky enough to get that point right there, and you do need trader's luck, by the way, then you can have the market does work your favor, and you're okay. The question comes: is 38.2 good for any time frame? Yeah, I use it. I use 5 minute. I use the hourly. I use the daily. But and you'll find it. Maybe we'll go at the end of this course. We'll go take a look at the euro-dollar chart, and I'll show you how I use it in, say, the 5 minute chart on a move here today. But yeah, this is an area of convergence or confluence, is what they like to say. So that's a nice little start to our trend to the upside. We don't know how far it's going to go. Now, we know because we're looking at it right now. But at this point, we don't know how far we're going to go. We just know that we have a good level. We have a level where we can define risk, where we can limit risk, where it holds 38.2% retracement, and that's good for the bulls, okay? And so we're bullish here, and the market starts to move up. Even if you buy at this point right here, your stop is if the market goes below the 38.2. So you're risking a relatively little amount on this trade, and what you're hoping for is a break of this high, and then we'll see how the market goes from there. And the longer you can stay on the trade, the better off you are. But catching any of this, risking a little, making more than a little is a good thing. Of course, we want to catch the whole trend. That's where the most of the money is made. But we'll just play along, that we get long and we make some money because we had limited risk. We understood the 38 points. So enough of that. So now let's take the next leg to the upside. We got long here, got long in here. The market started to move to the upside, and then we hit a point. When the market trends like this, we can draw things like trend lines, and once we have a low here and a low here, we can draw a trend line that goes up, and lo and behold, it holds at point number 3 here. So now we have a roadmap using a trend line that's forcing the market to the upside. Are we using Fibonacci retracements in this move to the upside? Not necessarily, because they're not, we're not retracing a lot. We're trending fast. Trends are fast, directional, moving in a range or in ranges that are outside of the norm. So we did 182 here, and we corrected, and now we're doing a lot more than 182. In fact, the market for 2 to 3 days was 275 pips from this low to here. And this is really, if I were to characterize the start of the trend, it was here, okay? This was the start of the trend. People would say, oh, well, the trend started at this point right here. The trend is down here. We're below the 100-bar moving average. We're below both the moving averages. But in this day right here, where this market started to move above the 100 and 200-bar moving average, this is really the start of the trend. All right? That is where the bias turned from negative, below the 100-bar and the 200-bar moving average, and started to move to the upside, to be more positive. And once you're above, this is where it all started. So this is going to be a key level for me. This is the start of my trend. I hope everyone sees that and doesn't see this as a start of the trend. Trend really started right here. Before this part, the trend and the bias was down. At this point right here, the trend of the bias is to the upside. So anyway, let's take, so what I will do is, we have a trend line here, and what happens here? The trend line is broken. So guess what? As soon as the trend line is broken, look for the retracement. The market is not trending anymore to the upside. It just broke the trend line, so there's a chance that this market is likely going to correct, go sideways, do something to that effect. It's not time. It's not time to go long, but it is time to start to measure the corrections and look at this 38.2 and see what this 38.2% retracement level does. And if it holds that level, what does that tell you? They're buyers here, okay? They're buyers that are supporting against 38.2, are willing to come in at that level before 50%, before 61.8. They are excited about getting on the trend at that level. So what do we see? We see this is a Friday because we have this gap here on Monday. So the Friday comes down, we break through the trend line, and the market's going down. We come down to test the 38.2. We have the early buyers, and the market moves up. On Monday or Sunday night, the market opens the week at the low for the week, and what does it do? It goes right below the 38.2% retracement and then bounces back. And for the rest of the Asian session, the market stays in a very narrow trading range, and what does it do? Holds the 38.2% retracement. Is that significant? Yes. Can you define risk against this 38.2% retracement? Yes, you can. Can you limit your risk against that level? Yes. Can you keep your fear to a minimum because you're limiting your risk, you're using the least amount of risk, and you defined your risk, and that risk isn't a lot? Yes, you can. All of that is working to your favor as a trader. You're able to use this 38.2% as a level to lean against. It's all about leaning against. As long as you can define your risk and understand your risk and take your shots and try to put the odds of success in your favor, you're going to catch some of these. You're going to catch some of these. You're going to catch some of these. And it's just a matter of understanding where those levels are and where you can lean against. The best traders in the world lean against levels, and that's what you as a trader must do as well. So the 38.2% retracement comes down, holds this level right here, and then we have this very narrow trading range in the Asian session, and what do? We get a big break to the upside. Is this a clue that, maybe something's starting here? Maybe we have that chance to hold the 38.2 and break through our old highs right here. Yes. All this confirmation. You can buy through here and risk through the 38.2 and be happy, or risk the 100-hour moving average. That's your risk. Half a box, okay? Half a box in this grid, right? That's your risk. Now let's measure half. That's a half. That's another half. That's another half. That's another half. That's another half. That's what you're trying to do as a trader, is risk a little, make more than a little, I like to say. I'm not going to guarantee you're going to make $1 million. All I'm going to say is you're going to make more than a little, okay? And that's what, and depends upon how far you can take this, whether you buy. But everyone sees the importance of the 38.2% retracement. Measure the 38. This is the last leg, trend to the upside. We correct that trend, and the market moves higher. I didn't go all the way down here. Why? Because this is a leg to the upside that took this market up here. The market likes to test that leg, okay? If the shorter leg can hold the 38.2, that's better than the longer leg holding, okay? This is saying even better. This is even better. Let's read even better. It held the short leg of the move to the upside. All right. This is just something that reiterates what I've been harping on. If the 38% of a trend move holds, look for an extension above the old high. Okay, that's just a little rule of thumb that I like to look for. So you can try to anticipate that when the market holds this level, it should take out this high. So let's take a look at the next leg to the upside. So the market moves sharply to the upside here. Market moves from a low of 128.74, moves up to a high of 130.15. So that's 29.74, 131.50. So that's 180 pips or so, 70 pips or so to the upside. Well, 181 pips there to the upside from the low to the high. Not a bad move. Really quick. Came off to 38.2. work like a charm. And then what do? The market then starts to move down off of that level, and we get a pretty good correction move. We get a move to the upside. This isn't a trend line right here is kind of it's very steep. You can see how steep this is. It's a little different than this move right here where we had a trend line kind of crossing over at this point right here. So what you see is, as a trader, when you see the high price come in here, you see a correction, a lower high. You're automatically starting to put in your Fibonacci retracements. We've gone outside the normal range for a day already anyway, 181 pips to the upside. So put your Fibonacci retracement from the low to the high of this leg to the upside. And look here, the 38.2 holds, right? It holds. It happens to hold the retracement level. So what do you expect? You expect the market to go out and take out the old high, or that's a target on the upside. We don't know if it's going to get there. What we do know is that we can define risk against this 38.2. And so then what does the market do? It goes up and takes out the high, and it fails up here. Just breaks above, fails up there, leaves this nice little tail here, and anyone who's probably looking at candlestick charts, probably looking at this and saying, oh, it's got to go, that's a failure on the top, and sell it down. I don't know what you call it, but the market moves down, and what does it do? It comes down to 38.2, tries to move up, and breaks to that 38.2 and goes down. So what do we know? We know that the market's losing a little steam here, isn't it? It didn't hold that 38.2 and break up to the upside here. It ran out of steam. It started to consolidate. The gain here. This gain that started at this point right here, this trend that started at this point right here, starts to consolidate at this point. You can probably put a trend line across here, and it started to break through the downside. If I had the trend line, you can imagine 1, 2, 3, break through the line right here, come down, break through the 100-bar moving average and that. So we're seeing that consolidation start to happen. Foot off the gas pedal. Trends starting to slow. We need some more clues. We need this market to get through its level. We start to get highs. Highs starting to form up here, a ceiling up there. We break below the 100-bar moving average, come below the 61.8, move back above the 100-bar moving average, and then starts to move to the upside. But what can we look at as well during this non-trending period? Well, instead of just looking at this little leg to the upside like I did on the previous chart, so this leg to the upside, that was kind of all came unraveling when the market failed up here and when it broke through that level right here. So instead of looking at this leg, let's take a bigger picture back and go back to where this whole thing started. This is where our trend started. Our trend to the upside started at this point, and we go to the high, and what do? We measure down, and what happens? 38.2% retracement level holds down up here. Holds down here. Right at this level, the market finds support against 38.2 of this longer move right here. So when you can't, this is another technique that I like to do. When the market starts to consolidate, and it's clear that the market is consolidating here, failure up here, move back down below the 38.2, move back and forth, have a ceiling up here, and take a step back, look back and go back to another low, go back to where this trend started, and take a longer view of where this market can correct down to. And don't stay out of the market here, but be aware that this 38.2% retracement level is still here. And when the market comes down to that level, breaks through the 100-bar moving average, this market should be going to the downside. Broke through the 100-bar moving average, should be heading down to this level, but it doesn't. It holds the 38.2% of the longer trend, where this trend started. Is it important? Yeah, it is. It is. And so it holds that level, and the market then the market moves back above the 100-bar moving average, and boom, off to the top side. So use that technique as well in your trading. If a leg to the upside gives way, and it's not as bullish, it doesn't keep that bullish trend going like we saw in this move, like we saw in this initial move down here. It failed up here and started to come down. Take downshift, move your Fibonacci down to another key level, and see, where this market can go. This is where traders start to say, we have a potential to move down to the 129.27 level when the market's, when the market's at 130.50 level, because they see it failing here. They see it going down. This is what target. This is the level where we're going to. So another key level, and once this holds right here, it's saying there's buyers, there's longer-term buyers against this level. We have room to the upside. So what happens? The market finds the bottom right here. We moved sharply to the upside. We have a trend line coming in across here. Here, the market breaks through the trend line. The trend is broken. And where do we come down? We come down toward the 38.2. Market breaks on two little occasions. Again, this is in the Tokyo session, the opening Asian session. The market kind of dips below there, moves a little bit up higher, comes down again in the beginning of London session. Finds support against that 38.2. Breaks a little bit below. Can't get below. Can't get below the previous low. Can't get below this old high right here, which was our ceiling over here. And the market says, okay, we're going to take another leg to the upside, and that's how it ends. So we end even the trend by holding the 38.2 and moving to the upside. Ironically, or not ironically, I'm not surprised by what happens in the market. Oops, I am surprised. Oops, now I did it. Let me get my charts back up here. There we go. What do we do here? I'm sorry. I'll get it back up. All right, can you see that chart? I mean to do that. I want to go this way. When we hit our high here, we start to come down and we start to clearly break through some trend lines and start to consolidate up at this level. And it's not when the market starts to do this up and down, break below the 100-hour moving average, come down to the 200, break below that 200-hour moving average. Does this remind you of this move right here? Remember when we looked at this trend to the upside and looked at this move and took it back to where this trend started? Well, let's take it back to where the trend started, move all the way to the upside, come up here to the 200-bar moving average, breaks below the 200-bar moving average, and where do we find support against? A 38.2% retracement at 130.29. So trend to the upside, consolidate, hold 38.2% retracement, and what do we end up doing here today? Breaking to the upside, the markets continued the trend to the upside. So anyway, you see a lot of that happen. Now today, this is euro on a daily chart, and what do we see in the euro here is that the market off the daily chart, and someone asked, can you use it on other time periods? Here, the the move to the downside from our high in October down to our low. And where's the 38.2? 132.42.9 here. And what did the market do when the market came up toward that level? We reached a high of 26. So it got within about 16 or 17 pips of that 38.2% on the daily chart. Now these are big numbers, but you can see how the market found those sellers against the 38.2. We found sellers against the 38.2. Again, people can define their risk. Longer-term traders can sit there and say, okay, well, I can define my risk against the 42 level. That is where my risk is. So I'll sell at 26, 25, 20, 16 or something like that, and I'm going to risk 12 pips. Maybe they're long when the market broke above this trend line right here and been riding the trend. So the market then comes off, and what do we do here today? We broke above the 26 level. We also broke above the 132.42.9 level, which is the 38.2% retracement level. Now, if we were to I'm going to take our charts off here, and I'm going to take my PowerPoint off. I'm going to bring up my charts, and here's our daily chart that we're looking at there, and the market has at 132.42.9 level as a level that we're breaking above here today. The 42 level is the 38.2% retracement, and we're above that level. It's going to be key here on the close that the market closes above that 38.2. If it does, then we should see a momentum or a further momentum to the upside here, and that momentum should, on the daily chart at least, going to target 133.37, which is our 100-day moving average. Haven't been above the 100-day moving average since October 28th, 2011. So that's how I'm looking at the market right now. Taking a look at the, well, let's go to the 5-minute chart here. Make it a little bigger here. And if I put a horizontal line here at the 42 level, that's our 38.2 on the daily chart. We see here that the market did come down a little bit and tested that 42 level. Also tested a nice little parallel or trend line here at that level. And note here the leg to the upside. What's our 38.2? 132.23. Our low on this last leg to the downside came in at 36. So we had a Fibonacci retracement at the 33 level, and the low came in at 36. So we're so far keeping the bullish bias here intact here for the euro versus U.S. dollar. Sharp leg move to the, look how the 100 and 200 bar moving average were converged right here. Remember I talked a little bit about that. And how on, well, we'll put a Fibonacci from our low to our high. So this is our first leg to the upside. Market came down to that 38.2, moved a little, well, this wasn't the high, this is the high right here. Moved just a little below that level, but couldn't close below that 38.2. And this is kind of the clue that, you know, an early clue that the market had the potential to move to the upside here. And from that point, we've seen a little bit, you know, taking out the high, come down the big leg to the upside, holding the 38.2. So things are still looking a little bit more a little positive here for the euro versus the U.S. dollar on our 5-minute chart, showing that you can use these charts in other time frames as well. And once again, I do like to force the market, if the market is able to hold a leg's 38.2% retracement. So not going all the way back to here. If the market were to break the 38.2, then I'd go back to that point and kind of move the whole move up to the top side here. But if the market can take this last leg and hold 38.2, what does it say? It says that the market has buyers still there. There are still buyers against this level right here. And if the market can hold that level, it has the potential to really squeeze any shorts out there, force the market back up to the, keep the market bullish, force the market, those people who are shorting the market to buy and squeeze them to the upside. That's what trends are. It's just squeeze after squeeze after squeeze, and a lot of times it comes off of that 38.2% retracement. So that's how I like to use the Fibonacci retracements in my trading. Now, I do have some time here for some questions. And one question that Len has come in is, do you ever run fibs from different levels and look for different fibs meeting at various confluence areas? Yeah, you know, you don't want to get, you can. Do I do it? Len, that makes perfect sense. Do I do it regularly? No, not myself personally. I like to keep things very simple but I see your point. Let's say, you know, what Len is saying is, let's say you get this shorter move to the upside, and then you have this longer term move to the upside, and he's saying, like, assume the 61.8 and the 38.2, or this area would be a level of support. 38.2 of the big move to the upside, 61.8 of the smaller move to the upside. Makes perfect sense to me, Len. Do I do it often? No. Could you as a trader use that level as a key support level? Absolutely. It gives you anything that gives you confidence, anything that defines your risk, Len, anything that makes sense, that you can see other traders doing, because remember, they have to be along with you, is great for your trading. And even if traders aren't doing the two leg that you're looking at, like this leg to the upside and this leg to the upside, and finding support region in this area right here. And they're just looking at the longer-term move to the upside, looking at 38.2 right here. It's getting the same thing. This is just giving you a little bit more confidence in what you're trying to do, how you try, where your entry level is, and and if you have confidence in your trading, if you define your risk, if you use logic, if you in your approach, what I teach is not necessary. It's not difficult. It's just logical and levels that other traders would likely see. And if they can see it, then guess what? Hopefully it'll work and it'll all work out. So the question comes in: what is the last frontier in your fib valuation? 61. It's 61. That's the one I use. The Town's asking if 78 point. I think it's 78.3. If I use that, what I'm going back to my mission statement and game plan. My game plan is to trade the trends and keep fear to a minimum. If you can trade trends, folks, if you can catch one trend, if you could in a month, you're going to be okay. You're going to probably do pretty well that month. You can catch, more little trends you can catch, whether intraday or longer, the better off you're going to be. So, in Fibonacci retracements, if you're retracing a move, let's say to the upside, like we've seen here today, and it comes down 78% or something, guess what? That trend is almost going the other way. So I would like to see what happens at the 38.2. If it breaks below 38.2, now I'm looking, well, is this going to reverse and start to go the other way? Are we going to get through the 50% retracement? What is our progression from that point? Because we know the currency markets go up and down. I don't like that. I like trending markets where it holds 38 and goes back up, and holds 38 and goes back up, or holds. And sometimes, by the way, what we saw in our example was the 38.2 work a number of different times, and that is indicative of a pretty good, strong, bullish market that caused the market to go up 600 pips in a short period of time. Don't discount the 50% though, because sometimes the market breaks that 38.2, comes down to the 50, and you get a spike back above the 38.2. That's also a nice little indication that the market still has buyers. Yeah, it got through the 38.2, maybe stops were hit, maybe stops forced the market down to the 50%, but holding the 50% and moving quickly back above that 38.2, that's also a nice little, you may sell and think the market's going down and get stopped out when the market moves back above that 38.2. But don't worry about that. That happens, So, do I often use projected fib levels like the 127 or the 150 or the 161? Sometimes, especially when the markets are moving outside of ranges that we haven't been in a while. Oh gosh, I'm trying to think like let's say the Swiss franc in this chart, on this hourly chart, the market moves to the upside and it might break through the low here, and there's nothing really here going back for a long while here to kind of put your hat on. And this could be a daily chart, it can be an hourly chart, it could be whatever. So I will I'll use these levels at a target. I also use I use trend lines and I use moving averages, as you kind of seen in those are my three tools. Fibonacci's are just not it. It's not all those three tools come into play in my analysis. But I'll have them in there. Is it and use them, especially when the market, there's nothing really to grasp onto once it breaks through a low or a high or something like that. Hope that helped you out a little. Okay, where is your initial stop loss? The Joker is asking, and this is no joke, but what in my trading, And what I'm trying to do is remember my mission statement: to make the most amount of money with the least amount of risk. So what that means is that what I want traders to do and look to do, and how I look at the market myself, is to trade near these key borderline levels that I like to call borderline, because on one side it's bullish, on the other side it's bearish. And I expect that there's going to be some energy around that level. Either I'm going to be right, excuse me, right, and the market's going to go in the direction of the trade, or I'm going to be wrong and the market doesn't do what I thought it should do. And I would expect actually the market to then have momentum in the other direction. That's the importance of a technical level, is that and this is my last point because we're running out of time. The importance of a key technical level, like a 38.2, like a 50% retracement, like a 100 and 200 bar moving average, is that you get a reaction off of it. Either that reaction leads to, like we saw here, this is our move to the downside. We remember it very clearly now, where we came down to the 38.2. The market, but the initial reaction is through the 100 bar moving average, and we get a reaction in the direction of the break. And sometimes that reaction leads to another target, which was a 38.2, and that, if it broke to that level, it would lead to the 50% and the 200 bar moving average. That's the roadmap that you're going. But if the market can't get through that level and starts to move back down, so if you sold at this 100 bar moving average and comes down to this level and can't get through that level and starts to move back above the 100 bar moving average, you're out. You're out. You're getting out. So my stops are close, 15 or 20 pips away from these key levels at the most. And sometimes I'll get the reaction off of the level. So assume that the market came down here. I knew my 38.2% retracement was here, and I buy against that level or buy in this area. I know I need to get above the 100 bar moving average, and I see the market move up to the 100 here and stall at that level and then come down again. My stop doesn't have to be 15 pips below the 38.2 now. It could be 5 pips below the 38.2, because now if the market broke, if I bought against the 38.2, and we don't see it here, but we know from our example, if I bought against that 38.2 and the market goes up to the 100 and stalls at that level and starts to come down, I don't need to risk 15 pips on that trade. It's a trade that hopefully will lead my way. I'm just trying to minimize my risk. So I'll move it up to 5 pips at that point. If it goes 5 pips below the 38.2, I'm out, or 10 or 7 pips or 8 pips or something like that. So that's the way I look to manage the position, kind of dynamically, minimizing the amount of risk. So that's it for today. Thank you very much to the people at FX Street. Thank you very much. Great crowd. I appreciate you coming in. Good fortune with your trading. We'll talk to you again later on this month. I think it's around the 20-something or other. I don't know. One day. Linda Moore will put it in. Thanks a lot. Bye-bye now.